Hello, everyone, and welcome back to the channel. So, it's been a couple of days since I started the series, and I haven't bought anything yet. Well, this is because, like I mentioned in my previous videos, I am expecting a weaker than usual September because historically, right, September is just a weaker month, and then we have a lot of attention on the upcoming rate cuts, right? Which I think the Fed has more or less confirmed that it will be cutting interest rates by 25 basis point this coming, I think next week. But the thing is, what Powell is going to say in his statement, right, would likely create some form of volatility, I believe, on the upcoming rate cut pathway because I think the market is now heavily pricing in and expecting maybe two or three rate cuts coming soon. But if Powell diverts from that path but a little, right, it could create even more buying opportunity as the market pulls back further. So I have been looking around for companies to invest in, and I have two in mind that I would deep dive further into, right? So just a disclaimer first before I begin, right? This is not financial advice. I do not own shares of these companies yet. I may buy it, but that doesn't mean you should, and you should always do your own homework. So what I'm doing now is a very quick skim through of the opportunities that I will look at first before doing deeper research and eventually buying maybe a starter position or just invest heavily into. So there are two companies in mind, but before I begin, I'd like to share with you a very quick checklist of how I decide whether a company is worth deep diving into, right? So number one, very, very, very easy thing to identify is if the business is growing. So this could be in terms of its financial statements, right? You need a business that is growing in terms of its sales, so its revenue. You need a business that is growing in terms of its cash flow, operating cash flow particularly, and eventually free cash flow. And you want to see a company that is profitable or showing very strong signs that it will be profitable in the future. So that is one. So not just in terms of these financials, right? You can also look at industry reports to tell whether a company is taking up bigger market share, which is something you want to see as well. This means that consumers or their customers just prefer their products more and they are switching over from other alternatives out there. And number two, right, is whether the company has decent and attractive valuation. So I think decent and attractive is relative, right? You can't just look at valuation as a standstill. So this would mean that if you think that a company that's growing very fast has a PE ratio of say like 100 versus a company that's growing very fast that has a PE ratio of 50. So which one would you prefer? I think it depends on the context. So how fast are they growing? What industry are they in? Are there headwinds or tailwinds that's driving the business further ahead? And I don't think you should look at it at an absolute number as well. So I think if you are always avoiding companies that have high PE ratios, right, you will only end up screening for very traditional businesses that aren't growing as much, but are showing like steadiness in this business. So you only get that, and those stocks may not always give you the outsized returns that you want. So I think it's very important to take into account relative valuations. Number three, strong underlying fundamentals. So when I say fundamentals, maybe in terms of their balance sheet strength. So is it steady? Is the company showing signs that it will survive? Is very strong? So some things that you look at is debt, right? Does the company have a lot of debt that it has problem like like financing, or is the company having a lot of share issuance? So some companies may not have debt, but they may issue a lot of shares to pay their employees through share compensation packages, or to raise capital by share issuance to fund their business. So but that's not a very good thing because if you keep diluting your share base over time, your current ownership stake would have like a smaller but proportion and percentage compared to the overall ownership float. So that's not something you want because you are getting diluted away. You want a company that is doing it at a moderate pace because, as you know, the growth companies usually they will issue shares to finance their growth plans. But you have to do so moderately and showing signs that it's starting to pick up, and eventually, I think the companies may have share buyback plans. So number four, the company must be forward-looking and writing a narrative. So I think if you want to uh, gain outsized return, right, it's either you know something about the entire space or the company before the entire market catches on, which gives you the outsized market return. So, for example, you may be working in industrial space, you see something unique that's happening, something you spot something with your own eyes, you hear something, and then you're able to enter a particular stock or something before the entire uh, market does. Right? So this doesn't mean you trade on insider news, but it's just something that you observe and see in the sector. This will give you the outsized returns that you have because you have the information advantage, or you just write the current narrative which is trending and just write the trend. So in this current market in today's age, it would be the AI wave, right? So if you invested in Nvidia over the past few years, you've been making bank, volunteer things like that. You're getting outsized returns compared to the index, right? So this is what I mean by writing a narrative. Number five, so preferably, not always the case, the company preferably will be founder led. So a founder who brought the business from 0 to 1 and 1 to 100 has a lot of skin in the game. He knows the business well. He has the intrinsic motivation to drive the business forward. Compared to sometimes you have your corporate CEOs may just want to please the shareholders by you're doing your share buybacks, dividends, things like that, which may not be always the best case. They're not taking the risk to grow the business to make sure that it continues to take our market share. And but at the same time, you want to make sure that the founder, right, has a lot of not, I wouldn't say a lot, but some significant insider ownership for them to make sure that they continue putting the work to make the company grow. Because I think in the end of the day, money also talks, right? And I think another opportunity, which I think may be a bit harder and more painful to do, is to um, take advantage of big market repricing opportunities. So, for example, recently in the healthcare space, you believe like companies like United Healthcare is greatly mispriced. Its current drawdown is not reasonable or rational for just some of the current situation that it's facing. You may enter the business, and if when the tides turn, you have a lot of upside for the company to return back to its previous valuations. For example, another example would be Lululemon, which has suffered a lot of hit to its stock price recently because of its weakening sales, right? Which I will make another video for to talk about it and share my thoughts on Lululemon. But these are some of the things I look out for before I screen for a company. So there are two companies in mind that I have looked at. So number one is ZETA. So what is ZETA? So ZETA basically is an AI enabled marketing technology software. It operates an omni-channel data-driven cloud platform that provides enterprises with consumer intelligence and marketing automations across omni-channel. So they're like a real-time leverage on big data sets, AI to provide customers with like up to date, even predictive consumer insights and better their marketing approaches, which leads to better ROI for their customers when for the ad spend compared to just blindly investing into your social media ads or traditional media ads, right? So Zeta is a growth company. Its market cap is at 4.43 billion. So it's I would say it falls within the range of companies that market size that I want to invest in, right? Um, so looking at its price to sales ratio, it's at 4.25, which I feel is reasonable for its growth rate that it's showing right now, which I'll show later. Price to earnings is negative, so this is because the company is not profitable yet, right? So its price to earnings will be negative. Price to book, I think we will leave this out because it's usually for to compare companies with a lot of capital intensive assets. For example, your real estate companies, things like that. Yep. So scrolling, let's take a look at its financials. So I like to use Top Penguin's financial chart tools, right, to look at its historical valuations and any trends. So over here, I would pick out like its let's take away total revenue for now. Let's look at its valuations first. So I go to key ratios, quarterly basis over the 5 years, and then I will scroll down to its not P ratios, price to sales ratio, PAC ratio. Sorry, not PAC ratio. That's price to sales. So if you look at its price to sales ratio over time, it has fallen off very heavily from 20 close to 21 to today trading at about as you see later about 4.25. So it is traditionally undervalued compared to its historical mean, which should be around I would say around the 6.5 mark, right? And then if you look at its financials, right? So, oh, sorry, I like to use the the legacy view for this because it shows you like all the charts in one go, compared to the other view where you have to pick up one by one. It's for you to have more concentrated view. So previously, right, its market cap was trading at a high 6.2 billion, and now it's at 3.73. Last quarter, now at around 4.9. So this is a good opportunity, I would say. If the company continues to execute right, it should be able to go back to its previous market cap. So as you can see, revenue is growing very steadily, increased 16.65% over the past quarter. Um, Net income is still negative, right? But it's showing very consistent signs and high probability of it turning profitable very soon. As you can see, its expenses is also increasing at a much lower rate at 1.2% versus the revenue growth rate of 16.65. So gross margins at 56.43. So this is another risk that I have to consider when I'm investing to Zeta, right? Because usually for your software companies, your SaaS companies, your AI companies, those with very strong market share and pricing power, they will have gross margins close to the high 70s or 80s range. But in Zeta case, it's showing only 56.43%. So this could mean that it's not as strong as its positioning in the space, right? Because otherwise it'll be higher, it'll have higher gross margins for it, meaning that it could price stronger and higher compared to competitors, and consumers also stick with them. So there is some form of price weakness here, pricing competitiveness here. As I mentioned, that income is going to turn positive soon. EBITDA already positive. Operating cash flow very strong and positive at 42.05 million, increasing very strongly over time. So this is something you want to see from your businesses. Like you want to see it bringing more cash from its business, from its operations. Free cash flow already positive, grew 23.82% per year over year. That's good. Dividends, it doesn't pay dividend. PE, we're not going to look at that. Last quarter it was trading at 10.91, but now it's already at 4.91. So there's a lot of opportunity for it to go back to its previous high if it continues executing and it's growing, right? Share outstanding at 270 million. So this is not something you want to see from your businesses. And as I mentioned earlier, dilution is not good, but it feels like it is increasing at a much slower pace than before, increasing at only 2.21%, right? So this matrix by itself, at its growth rates, and I think it presents a very but interesting case to deep dive further, especially since if you look at the price charts, right? Sorry, pop up. It has retraced heavily from previous high, and if you're a technical guy, it looks like it's bottoming out, starting to build a stronger consolidation base before it goes higher. So technicals, from a price charting perspective, it looks attractive to me. Fundamentals, it looks attractive as well. And I think I would do a deeper research into Zeta to find out if it's a